In the early weeks of 2019, WeWork was worth $47 billion. On paper, that made it more valuable than American Airlines. It made it worth more than 27 of the 30 largest publicly traded real estate companies in America. Investors clamored to get in. Its founder was hailed as a visionary, a man who claimed he wasn't building a real estate company at all, but something closer to a movement. And then, in the span of roughly 6 weeks, all of it came apart. By late September, the same enterprise that had commanded a $47 billion valuation was scrambling for a lifeline that valued it at around $8 billion. An 84% collapse. Not over years, not over months, over weeks. To understand how that happened, you have to understand that this wasn't a slow bleed. It wasn't a market crash that swept everything down with it. This was a single, self-inflicted wound. And the strange, almost unbelievable truth is that the thing that destroyed WeWork was a document. A piece of paper the company voluntarily submitted, on purpose, expecting it would open the doors to Wall Street and cement its founder's legend forever. That document was called the S-1. And on August 14, 2019, WeWork filed it with the Securities and Exchange Commission. Now, an S-1 is a routine thing. Every company that wants to sell shares to the public has to file one. It's meant to be a confidence builder, a formal introduction to investors that lays out the numbers, explains the business, and reassures everyone that this is a company worth betting on. Bankers polish these documents for months. They're designed to be boring in the best possible way. They're supposed to say, nothing to see here, everything is under control. WeWork's S-1 did the opposite. It ran 350 pages, and instead of reassuring anyone, it detonated. When investors, analysts, and journalists finally got their hands on it and started reading, what they found wasn't a story of controlled growth. It was a portrait of a company hemorrhaging money at an almost incomprehensible rate. $1.9 billion in operating losses against $1.8 billion in revenue. Read that again. The company was losing more money than it was actually bringing in. And that was only the surface. Buried in the language of that filing was a web of arrangements that made seasoned professionals stop cold. There were invented financial metrics, terms cooked up to make catastrophic losses look like something resembling profit. There were governance structures that handed one man near total control, voting power that dwarfed every other shareholder combined, and the ability to sign away the company's future with a single signature. And there were transactions, deal after deal, that pointed back to the same person on both sides of the table. That person was Adam Neumann, 6'5", Israeli-born, a former naval officer with a failed baby clothing business behind him and an almost hypnotic gift for selling a vision. He had co-founded WeWork in 2010, in the wreckage of the global financial crisis, and by 2019 he sat atop one of the most valuable private companies on earth. He had convinced some of the most powerful investors in the world that he was building the future, and he had structured the company so completely around himself that, as the S-1 revealed, he'd even sold WeWork the rights to a single word from the dictionary and pocketed millions in the process. The market read all of it, and the market recoiled. What followed was one of the fastest, most complete collapses of confidence in the history of modern business. A $47 billion valuation didn't just decline. It disintegrated. Wall Street told its clients to run. The IPO target was slashed and slashed again, and then abandoned entirely. Within weeks, the founder himself was pushed out the door. This is the autopsy of that unraveling. How a company built on a story of community and belonging came undone the moment it was forced to show its work. How the very document meant to save it became the fuse that blew it apart. And how one man's ambition, unchecked and unbounded, wrote the ending long before anyone was willing to read it. To understand how it ended, you have to go back to how it began. And it began, as so many of these stories do, in the ashes of a crisis. The year was 2010. The global financial system had just cratered. Office towers stood half empty, commercial rents had collapsed, and the conventional wisdom said real estate was the last place any sane person would build a fortune. It was exactly then that two men saw an opening. Adam Neumann was 6'5", Israeli-born, a former officer in his country's navy, and a serial entrepreneur whose previous venture, a line of baby clothes with padding built into the knees, had failed. His partner, Miguel McKelvey, was an architect raised in a communal household in Oregon. Together, they had already run a modest experiment called Green Desk, subleasing a single floor of a Brooklyn warehouse for $5,000 a month and renting out individual desks for $350 apiece. The math was elegant in its simplicity. Take cheap space, divide it, and sell the pieces for more than the whole. That was the entire engine of what came next. Sign a long lease on distressed real estate, carve it into desks and glass-walled offices, and rent them out flexibly to freelancers, startups, and anyone allergic to the corporate cubicle. On paper, it was arbitrage. Real estate arbitrage, the oldest game in the book. But Neumann understood something that spreadsheets don't capture. Nobody funds arbitrage. Nobody writes a check for a subletting operation. What investors fund is a story. So he told a different one. WeWork, he insisted, was not a real estate company. It was a community, a movement, a place where the isolated and the ambitious would find one another and, in his words, elevate the world's consciousness. The offices came with beer on tap, kombucha, fruit water, exposed brick, and neon slogans about doing what you love. The aesthetic screamed startup. The vocabulary borrowed from Silicon Valley. And the pitch positioned WeWork not as a landlord collecting rent, but as a technology platform, a network, a lifestyle. That distinction mattered enormously. Real estate companies are valued on their assets and their income. Tech companies are valued on their dreams. By dressing an office leasing business in the clothes of a social network, Neumann unlocked a valuation the underlying numbers could never have justified on their own. And the growth was staggering. WeWork opened locations at a furious pace, planting flags in city after city. By 2018, it had become the single largest private tenant in Manhattan, in London, in Washington, and in Tel Aviv. It operated across 27 countries with 15,000 employees. From a floor of a Brooklyn warehouse to a global empire in less than a decade. The speed alone was intoxicating, and speed has a way of silencing questions. Then came the man who would pour gasoline on the fire. Masayoshi Son, the chairman of SoftBank, controlled one of the largest pools of investment capital on Earth. In 2017, he met Adam Neumann. The meeting reportedly lasted 12 minutes. 12 minutes, and Son committed $4.4 billion on the spot. But his instruction to Neumann was even more revealing than the number. He didn't tell him to be careful, or disciplined, or profitable. He told him to be crazier. To make the company 10 times bigger. That was the philosophy that now guided WeWork. Not sustainability, but scale. Not caution, but conquest. In January of 2019, SoftBank led another round of $2 billion, and with it stamped a valuation on the company that defied belief, $47 billion. Sit with that figure for a moment. At $47 billion, WeWork was worth more than American Airlines. It was worth more than 27 of the 30 largest publicly traded real estate investment trusts on the market. A company that had never turned a profit, that leased space and rented desks, was suddenly valued above nearly the entire industry it claimed not to belong to. Neumann's charisma had done its work. He had convinced the smartest money in the world to fund the dream and ignore the arithmetic. The valuation soared on a story, and the story soared on him. But stories, eventually, demand a reckoning, and the fine print was waiting. On the 14th of August, 2019, that fine print finally saw daylight. To go public, a company has to file a document called an S-1 with the Securities and Exchange Commission. It is not a pitch. It is not a keynote delivered from a stage with the lights dimmed and the music swelling. It is a legal disclosure written under threat of federal penalty, and it demands that a company show the world its actual numbers. For 9 years, WeWork had been a story told by a charismatic man in a room where he controlled the temperature. Now, for the first time, the company had to put itself on paper. 350 pages of it. And the moment analysts opened that filing, the spell began to break. The first thing that leapt off the page was the losses. WeWork had generated $1.8 billion in revenue. An impressive figure, until you saw the number sitting right beside it. Operating losses of $1.9 billion. The company had lost more money than it had earned. And this was not a young startup taking its first hits. This was a scaled, global operation, and the more it grew, the more it bled. Revenue and losses were rising in lockstep, arm in arm, like two runners who could not be separated. Growth was not a path to profit. Growth was the engine of the bleeding. Then the analysts looked closer at the shape of the business itself, and they found the structural flaw hiding in plain sight. WeWork signed leases with landlords that ran for 15 years. Fixed, binding, non-negotiable commitments to pay rent for the better part of 2 decades. But the tenants it filled those buildings with, they signed up month to month. They could walk away in 30 days. So the company had locked itself into long-term obligations while relying on short-term income to cover them. When times were good, the desks were full and the money flowed. But the debts did not care about good times. The lease obligations stretched to $47 billion over their full term. Read that again. The company had promised its landlords more money than the company itself was worth at its absolute peak. It was a mismatch built into the foundation, a structural bet that the good times would simply never end. But the detail that turned skepticism into ridicule was a single invented phrase, buried in the accounting. WeWork's bankers, faced with numbers that refused to look profitable, did something remarkable. They created a brand new metric. They called it community-adjusted EBITDA. Now, EBITDA is a standard measure. Earnings before interest, taxes, depreciation, and amortization. Companies use it all the time to strip out certain financing effects and show underlying performance. But WeWork went further, much further. Their version excluded rent. It excluded the cost of staff. It excluded marketing. In other words, they built a measure of profitability by removing the largest and most fundamental costs of actually running the business. Rent, for a real estate company. Salaries, for a company with 15,000 employees. Marketing, for a brand that sold itself on lifestyle. Take away everything you spend money on, and yes, you look profitable. But it is not accounting. It is a magic trick performed with a calculator. And this was the collision that the S-1 laid bare. For 9 years, the company had spoken a language of consciousness, elevating the world's consciousness, community, energy, a new way of living and working and being. It was a vocabulary designed to make you feel something, to lift you above the grubby details of rent rolls and occupancy rates. But the SEC does not care about consciousness. Analysts on Wall Street research desks do not price energy. When cold accounting reality was finally allowed into the room, the poetry evaporated. What remained was a company burning roughly $250 million every quarter, holding only $400 million in cash, and asking the public markets to hand it billions on faith. The dream had been forced, at last, to speak the language of arithmetic. And arithmetic does not flatter. Buried inside that 350-page filing, past the losses and the strange metrics, was something that changed the mood in every conference room where investors read it. Because the numbers were bad, yes, but numbers can improve. What they found next spoke not to a company's performance, but to a founder's character. And character does not improve on a spreadsheet. Consider a single arrangement, one that would have raised eyebrows at any company in any industry. Adam Neumann personally owned stakes in 4 office buildings. Then, wearing his other hat as chief executive of WeWork, he signed leases committing the company to rent space in those very buildings. Money flowed out of WeWork's accounts, and some of it flowed into the pocket of the man deciding how WeWork's money should be spent. He sat on both sides of the negotiating table, shaking hands with himself. The landlord and the tenant were the same person, and that person answered to no one. Then there was the word we. Not a product, not a technology, not a patent for some breakthrough. A pronoun. One of the most common words in the English language. Neumann had quietly registered the trademark on it through a holding company he personally controlled. And when WeWork wanted to use the name it had built its entire identity around, it paid Neumann's private entity nearly $6 million in stock for the privilege. He sold the company the word that was already in its name, and he pocketed the proceeds. After the public backlash, the money was eventually returned. But the instinct behind it lingered, and investors do not forget an instinct once they have seen it. Now understand why none of this could be stopped from inside the company. Neumann held a special class of shares, one that granted him 20 votes for every single vote held by an ordinary shareholder. 20-1. It meant that even after raising over $16 billion, even after diluting his ownership across countless funding rounds, he retained near total command. The other investors were passengers. He was the only one with a hand on the wheel, and the wheel was welded to his grip. He could sign company documents alone, without a second signature, without a board member's consent, without anyone to say no. And the control did not end with his own life. Neumann had written into the arrangement that should he die, it would be his wife, Rebecca, who chose the next chief executive. Not the board, not the shareholders, not a search committee. His widow, a publicly traded company, or one aspiring to be, had built its line of succession around a single family's household. Rebecca was no bystander in all this. She had co-founded the company, and she carried real influence within it. Employees told stories of her firing people on the spot, dismissing them not for poor performance, but for lacking the right energy. Imagine losing your livelihood because a founder's spouse decided your aura was wrong. That was the texture of the place beneath the inspirational posters. Layered on top were the loans. WeWork extended credit to Neumann on generous terms. He borrowed against his stock. He used company resources in ways that blurred the line between his wealth and the firm's until the line stopped existing altogether. The corporation was not so much a business he ran as a personal fortune he inhabited. This is the moment where the tone of the whole story shifts. Up to this point, an outside observer could tell themselves a forgiving version of events. Maybe Neumann was a dreamer who got carried away. Maybe the losses were the growing pains of a genuine revolution in how people work. But the governance section allowed no such generosity. It revealed a structure engineered, feature by feature, to concentrate wealth and power in one man and to protect that concentration from any challenge. The word people started using was not risk. It was alarm. Because there is a difference between a company that is losing money and a company that is designed to serve its founder above all else. Investors had walked in curious about a bold experiment. They walked out convinced they were being asked to fund a monarchy, and no one wanted to buy shares in a kingdom. For a few days after the filing, the disbelief was almost private. Analysts read the document alone, at their desks, checking each figure twice because the numbers seemed too strange to be real. Then the private disbelief became public, and it became loud. Research desks across Wall Street, the same institutions that had been circling this company for months, began quietly telling their clients the opposite of what everyone expected. Stay away. Do not touch it. The firms that had once whispered figures like $96 billion were now advising their most valuable customers to keep their distance entirely. And the reason was simple. Once the fine print was on the table, the story fell apart under its own weight. The metric the bankers had invented, that so-called community-adjusted EBITDA, became a punchline within hours. Here was a measure of profitability that excluded rent, excluded staff, excluded marketing. In other words, it excluded the actual costs of running the actual business. Strip away the parts that lose money, and of course you look profitable. It was accounting as performance art, and the market saw through it instantly. Then came the deeper, more dangerous question. What exactly was this company? The pitch had always been technology, community, a platform, a movement. But when you read the S-1 with cold eyes, you saw something far more ordinary and far more frightening. You saw a company that signed 15-year leases on office buildings and rented out desks by the month. You saw long-term obligations stacked against short-term income. You saw $47 billion in future rent, a number larger than the company's own peak valuation. This was not a tech firm. This was a landlord. A heavily indebted landlord wearing a costume, and the costume had just slipped. So the valuation began to fall, and it fell in real time, in public, like a stock ticker running backward. The $47 billion figure, once treated as a floor, became a fantasy. By the 5th of September, the talk was $20 billion. Then the whispers grew smaller. $15 billion by the 13th. Then people started saying 10, and even that felt generous. In the span of a few weeks, tens of billions of dollars in supposed value simply evaporated, not because the buildings changed, not because the leases changed, but because trust had collapsed and nothing else was holding the number up. Because that is what was really eroding here. Not the valuation, the trust. And once trust goes, everything that was once charming becomes evidence against you. Every strange clause became a headline. The trademark on the word "we" sold to the company for nearly $6 million by an entity the founder personally controlled. The buildings he owned and leased back to his own company, sitting on both sides of the deal. The 20 votes per share. The wife who would choose his successor. The private jet. The tequila poured in board meetings. Individually, Each was a curiosity. Together, they read like a confession. And so the roadshow, the grand tour meant to crown this company as the future, turned into something else entirely. It became a defense. Instead of selling a vision, executives found themselves explaining it, justifying it, apologizing for it. Every meeting that was supposed to build excitement became an interrogation. Institutional investors, the pension funds, and the asset managers who moved the real money asked the questions no one had asked before, and the answers did not satisfy them. You cannot sell optimism to a room that has already stopped believing you. The press, sensing blood, moved in. What had been breathless profiles about a visionary founder became forensic examinations of a company in freefall. The narrative flipped from genius to spectacle almost overnight. And the man at the center of it all, who had spent a decade being told to dream bigger, to be crazier, to make it 10 times larger, suddenly found that the market had run out of patience for the story. The fine print had been read, and it could not be unread. By early September, the numbers spoke for themselves in a language no pitch could soften. The valuation that bankers had once floated at $96 billion was collapsing in real time. First it dropped to $20 billion. Then, by September 13th, to 15. Every day brought a smaller number, and every smaller number told the same story. The market had assigned a price to Adam Neumann's vision, and it was a fraction of what he had been promised only months before. On September 16th, the inevitable arrived. The initial public offering was postponed indefinitely. There was no polite way to frame it. The company that had been the most anticipated debut of the year had been quietly pulled from the runway before it could ever take off. 2 weeks later, on September 30th, the offering was formally withdrawn. 6 weeks. That was all the distance between the filing of the S-1 and the total unraveling of the plan that was supposed to make everyone rich. But the failed IPO was not merely an embarrassment. It was an existential threat. WeWork had been burning cash at a staggering rate, and the public offering was meant to refill the tank. Without it, the company had roughly $400 million on hand and was spending it at a pace that left only about 5 weeks before it ran dry. The clock was no longer measured in quarters or years. It was measured in weeks. The visionary who had spoken of transforming how the world lived and worked was now presiding over a company that could not pay its own bills through the end of the month. The board, along with SoftBank, moved to remove the man who had brought them to the edge. On September 24th, Adam Neumann stepped down as chief executive of the company he had co-founded. The special voting shares that had once given him 20 votes to everyone else's 1 could not save him. When the money runs out, so does the power that money once bought. And here is where the story turns from tragedy into something harder to stomach. Neumann did not leave with nothing. He left with a fortune. His exit package included a consulting fee of $185 million. He sold shares back to SoftBank for roughly $970 million. SoftBank agreed to pay off his personal loans. All told, the man who had steered the company toward the cliff walked away with approximately $1.5 to $1.7 billion. He was rewarded, in effect, for leaving. To keep what remained alive, SoftBank stepped in with a rescue package. $5 billion in new debt and equity, plus a $3 billion offer to buy shares. The price attached to this bailout valued WeWork at $7 to $8 billion. Only months earlier, the figure had been $47 billion. An 84% collapse, erased in a single season. And then came the human cost, which no golden parachute could offset. In November of 2019, roughly 2,400 employees were laid off. Early the following year, another 4,000 followed. Before it was over, the job losses would reach around 14,000 people, nearly 90% of the workforce. The community that WeWork had sold to the world, the belonging, the shared purpose, the energy that Rebecca Neumann had once fired people for lacking, was dismantled desk by desk, office by office, country by country. The expansion reversed. The empire that had spread across 27 countries began to contract, shedding the surf schools and cookie brands and grand ambitions that had once seemed to prove how limitless it all was. The wave pool company, the private jet, the tequila poured in boardrooms. It receded into memory, a monument to how far unchecked belief could carry a company before gravity reasserted itself. Adam Neumann emerged from the wreckage a billionaire. Thousands who had believed in him emerged from it unemployed. Look at the arithmetic of that ending, because the numbers tell the truth the story tried to bury. Neumann walked away with roughly $1.7 billion, a $185 million consulting fee, nearly $1 billion from selling his shares back to SoftBank, and the added grace of having his personal loans erased. Meanwhile, the people who had assembled his desks and welcomed his tenants and poured the coffee at those famous community events were counting severance, if they got any at all. By November of 2019, 2,400 employees were gone. Another 4,000 followed in early 2020. In the end, roughly 14,000 people lost their jobs, close to 90% of everyone WeWork had ever employed. And the market that was supposed to grow forever simply vanished. When the pandemic arrived in 2020, it did the one thing WeWork's entire model could not survive. It emptied the offices. Demand for shared workspace collapsed overnight, but the 15-year leases did not collapse with it. Those obligations remained, fixed and enormous, a mountain of long-term promises pressing down on a company that had lost its short-term revenue. The structural mismatch that had always been the hidden flaw at the center of everything finally came due. SoftBank, the enabler-in-chief, absorbed the consequences of its own faith. By the end of 2020, Masayoshi Son had taken $9.2 billion in write-downs on WeWork, the single largest venture capital loss in the history of his firm. The man who once told Neumann to be crazier, to make it 10 times bigger, had gotten exactly what he asked for, and it had cost him more than almost any bet he had ever made. Still, the story refused to die quietly. In October of 2021, WeWork finally reached the public markets, not through the triumphant IPO that bankers had once valued at $96 billion, but through a SPAC merger, a side door, at a valuation of $9 billion, less than a fifth of its peak. And from the moment it began trading, the stock did only one thing. It fell. For 2 straight years it declined, quarter after quarter, while the company burned through roughly $300 million every 3 months. Still, after more than a decade, unable to do the one thing it had never once done in its entire existence: turn a profit. On November 6, 2023, WeWork filed for Chapter 11 bankruptcy. Its unpaid rent obligations exceeded $13 billion. Property owners across 40 cities swallowed roughly $7 billion in losses from leases that were signed with fanfare and broken in silence. A company once worth more than American Airlines, worth more than 27 of the 30 largest real estate trusts in America, ended as a cautionary line in the ledgers of every landlord who had believed the pitch. So what actually happened here? Strip away the tequila and the private jet and the trademark on the word we, and you are left with a simple mechanism. Hype attracted capital. Capital validated the hype. A charismatic founder was handed 20 votes per share and the authority to sign away the company alone, and the investors who should have applied the brakes instead pressed the accelerator, because the story was intoxicating and the fees were enormous. They invented metrics to hide the losses. They imagined valuations that had no relationship to reality. And it all held together, floating on collective belief, right up until one honest document forced the numbers into the light. That is the lesson of the 6 weeks. Not months, not years. 6 weeks between the filing of the S-1 and the withdrawal of the offering. It took nearly a decade and $16 billion to build the fantasy, and 42 days for it to fall apart. Because the moment the real figures appeared on the page, no amount of charisma could argue with them. A story is only as strong as the numbers underneath it. Investors will believe almost anything they want to believe. But the numbers were always there, patient and indifferent, waiting to be read. They never lie. They only wait to be asked.